When you mentioned 2008, I think you get everyone's attention. You said this: we offer further comparisons to August 2008. Mike, can we start there? What are the comparisons between now and back then?
Well, good morning, John. Yeah, I mean, the main one that we're trying to put forth is that our earnings model, which, as you know, we spent a lot of time focused on, the spread between our forecast now and what the consensus is modeling for next year is as wide as we have seen since the summer of '08. Okay, so in other words, we're looking for an earnings recession that could be as big of a surprise to the market as it was in '08. Now, what we're not looking for, and I'll make it perfectly clear on this, is a balance sheet recession, a systemic risk fall off like we saw in the fall of '08. So it's very distinguished, but it doesn't mean that there's still not a lot of price risk here. Okay, this is where we think we're out of consensus now and where we have high conviction. So a year ago, it was really about the Fed and the normalization of rates. And now this is the second part of our thesis. As you know well, the ICE part is now really kicking in. And there's this sort of presumption out there from our conversations with clients that everybody knows that earnings are going to be bad next year, and the market's already priced it. And we're just putting this warning out for folks who assume the market is omnipotent and it knows this. The market typically doesn't know these types of earnings declines before they happen. So that's the risk now, if we're right. Okay, we have conviction in our view. We could be wrong about that, but that's our work. And we think that this rally that we've had, which we identified and then got out of 2 weeks ago, we think that the technical price action last week was confirmation that rally is not only over, but it's about to exert itself on the downside again in a meaningful way.
Mike, can you explain what's behind that conviction? These are earnings for the quarter we're in right now. This is 4Q to be reported in the first quarter next year. What's behind that conviction, Mike? What do you see that's developing that maybe other people are missing?
I don't think I see anything that's that different, John. It's just the way we put it together. So remember, our forecast I'm talking about is for the next 12 months. Everybody focuses on this quarter, but the market doesn't care about this quarter's earnings. It never does. It cares about what's going to happen over the next 12 months. That's what the market really focuses on and tries to figure out. In our model, we've got 30 years of history of this thing. It does a really good job of using data that's already out there, mostly top-down data. Some of that's survey data, soft data, as we like to call it, that leads to hard data. And, the R-squared on this thing is 80%. So it doesn't mean it's infallible, but it's pretty darn close. And when the spread is this wide, you really want to pay attention to it. When the spread's 5%, it's like, that's kind of noise. The spread's 25%. So that tells us that, this is probably not in the price.